Hello, thank you for joining us today for our third quarter 2021 Market Touchstones slideshow. My name is Paul Latta, and I'll be doing the narration today, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. In today's show, we'll be touching upon the most important factors in the capital markets today. So far this year, the S&P is up just over 20% through the middle of September 2021, a solid start given that the S&P average return for a full year is about 10%. Main drivers have been accommodative central bank policy and optimism about putting the pandemic behind us and a return to work. We'll talk about all these factors and other details in subsequent slides. Today, our agenda has just three parts. We begin with central bank policy, since that is the key to understanding what is happening in the capital markets today, both in the US and outside the US. And then we'll discuss the various subsectors and other asset classes and look into the various hot spots and cold spots. And then we'll finish with some concluding thoughts. Most major central banks around the world continue to accumulate assets through quantitative easing programs. The US Federal Reserve alone has accumulated over $8 trillion in bonds here in the US. The central banks in other countries are also buying bonds at a fast clip. This slide looks at the four largest central banks to compare asset accumulation when measured as a percentage of gross domestic product. A few items to note here. First, you can see the large lift in central bank assets with the onset of the pandemic here about a year and a half ago. And then second, you can compare the current quantitative easing program with the original QE program back in the Great Recession of 2008-2009, and you can see that the current program of quantitative easing, well, it's much larger than it was during the Great Recession of 08-09. Lastly, and perhaps most importantly, you can see the US Federal Reserve program is actually not as large as programs in other central banks. That's an encouraging sign for the US dollar, since the US dollar is usually measured in terms of other currencies, and if they're printing faster in other regions, that would be strong for the US dollar. A bit of a contrarian conclusion. In our slideshow from last quarter, we discussed the early signs of inflation and the Fed's belief that these pressures would be transitory. The slide appears to add evidence to the Fed's thesis, though some inflation risk does remain. The chart shows that the U.S. Consumer Price Index, the CPI, spiked up to a 0.9% in June month to month, but has since softened to a more normal 0.3%. There's a similar trend in the Producer Price Index, the PPI, which is not shown on this slide. Much of the spike in June was driven by a handful of categories, mainly used car prices, higher airfares, and hotel rates. And these categories have since cooled off, perhaps due to the end of stimulus checks or perhaps due to fears around COVID with the Delta variant. But we're not out of the woods yet. Commodity prices do remain elevated, supply chain disruptions are prevalent throughout the world, and inflation in many regions outside the US is higher, creating the risk of imported inflation. So it seems unlikely that the monthly Consumer Price Index report will drop much further from here over the next year or two, barring, of course, the new deadlier COVID variant. But going forward, it also seems unlikely that we'll be revisiting the June highs anytime soon. One of the most asked questions is, when will the Fed start tapering its quantitative easing program? After all, more than a handful of banks around the world have started tapering theirs, Canada, England, Norway, and the Fed balance sheet is getting really big. What's the holdup? Well, the holdup in theory is the slow recovery of the job market, though we suspect the Delta variant is a bigger factor. Fed's on record saying tapering will start before year end, but in our call from last quarter, which was before Delta, we thought tapering would have started around August. We now think the Fed's in a wait and see mode on the Delta infection rates, and if the infection rates decline, perhaps we'll see a taper in the November timeframe, plus or minus a month. Europe, in contrast, they actually started a partial taper just a couple of weeks ago in early September, but they were cautious on the phrase taper, since they dropped bond buying from 80 billion euros per month to 65 billion euros per month, but we're not committing to further tapering beyond the initial drop. The Delta variant was not really discussed, but we suspect it's a factor behind their decision. So we put Europe in the tapering box here on the slide, but with a question mark. Some of the emerging markets are living in fear of the Fed tapering. Recall during the last go-around with quantitative easing, which began during the Great Recession of 2008-2009, some of the emerging markets were then clobbered by the Fed tapering of 2013. Not all the emerging markets were uniformly impacted. In particular, those with large trade deficits were especially hard hit. They were then known as the Fragile Five countries, which included Brazil, South Africa, India, Indonesia, and Turkey. Most of these countries still run large trade deficits and are still vulnerable. Yeah, not all. India's gotten a little bit better, but 4 of the 5 are actually still in a very vulnerable position and are watching with fear with the potential Fed tapering. Another emerging market vulnerability is overdependence on commodities. Global commodity prices have spiked mainly on the COVID-related supply constraints. This can create significant inflation in those economies where the majority of gross domestic product is derived from raw materials such as oil or mining or agriculture. Many of the Latin American central banks are actually now raising rates to defend against inflation and currency collapse, a very different scenario from that of most of the developed countries in North America and Europe. So all eyes are on the Fed as a move to Fed tapering will have a lot of ripple effects to other central banks in other countries around the world, each with a different regional interpretation, some positive and some negative. Let's move now from central bank policy to the hot spots in the market today in the third quarter of 2021. We'll lead off with physical assets, commodities, and real estate. The same leadoff item we chatted about in our prior call at the end of the second quarter. It's still hot. We'll also discuss the roaring high shipping rates, especially ocean shipping, and then we'll finish with a discussion of the return of large growth stocks to the top of the list after a couple of quarters on the sidelines. Let's begin with looking at the commodity market. Commodities in general have been rallying strong since just after the COVID sell-off in early 2020. This chart shows prices of 10 representative commodities from January 2020, just before COVID, until today. All 10 softened into the initial COVID quarantines and then exploded after the beginning of quantitative easing. For most commodities, the story is very similar, with demand improving as the economy normalizes, but supply chain disruptions are prolific. COVID restrictions have constrained labor, transportation is bottlenecked, cross-border movement is limited at best. The result is massive price increases. In a way, there are a few surprises in this chart. The chart is essentially a textbook ranking of commodities by global economic sensitivity. So the industrial metals like iron ore and copper are seeing the most upward pressure, whereas the agricultural food commodities, which are less economically sensitive, are seeing the least upward pressure. And the two non-global commodities, natural gas and lumber, are seeing the least correlation with all the rest. Indeed, you can see that huge mid-year overbought spike in lumber in light green finally giving way to a more reasonable pricing in the last couple of months. And natural gas in dark green has actually seen quite a lift just in the last month or two on the Gulf of Mexico production disruptions, mainly associated with recent hurricanes. Eventually, of course, we will get over the supply chain disruptions. However, commodities are priced on global markets, and so getting rid of supply disruptions requires a healthy global community, not just a healthy US community. This also means that lumber and natural gas may revert to normal before the rest of the commodity complex. Both real estate and stocks are forms of equity, and both are priced relative to interest rates. So with the 10-year Treasury down here at 1.3%, roughly half of where it was at the end of 2018, it should be no surprise that both real estate and stocks are soaring. It is a little bit oversimplified to say that if you cut mortgage rates in half, real estate prices eventually double. There is actually a directional correlation. Supply and demand also matter, of course. Demand is strong on recovery expectations, and supply is weak from suppressed building activity amid last year's quarantine. Inventory of homes for sale remains near record lows. These trends seem likely to continue for the time being, aside from seasonal variations and barring new virus variants. We have not really included any slides on commercial real estate, but that market too is interest rate sensitive and has performed very well in the last year, with some segments outperforming like apartments and others more challenged, such as strip malls. With commodities and real estate both seeing sizable price increases, inflation worrywart are fretting about cost push inflation. And while sizable raw material price increases have not pushed through to consumer prices, as we saw back on slide 5 on the CPI, there could be some evidence of cost push inflation taking place at the intermediate goods level. Iron ore prices have pushed through to higher finished steel prices. Higher crude prices have pushed through to higher gasoline prices. Shipping costs are one of those intermediate level costs that are neither raw material nor finished goods. For certain forms of shipping, costs have gone through the roof. The Wall Street Journal has been tracking container shipping costs, which have seen the most jaw-dropping increases of all forms of shipping. As you can see on the chart on the left, spot shipping container prices from China to US West Coast ports is up well over tenfold from pre-pandemic to today. Port congestion is the culprit as supply chain bottlenecks restrict throughput. The container market today has become more like an auction bidding market rather than its normal tariff market. The bottlenecks in container shipping have pushed through to other transportation modes, notably the global air freight market where airplane belly capacity is fairly limited. Other modes like truck and rail have seen less price escalation, but not zero. The spike in ocean freight is not sustainable, but debottlenecking the supply chain constraints may take months. And with higher costs of other inputs, a reversion to normal operating conditions may not result in a reversion to prior pricing. The large core growth stock style was the hot style in the third quarter, same as the second quarter, but for very different reasons. In the second quarter, growth stocks did well, mainly just as a reversion to the mean after a weak performance in the first quarter. But in the third quarter, growth stocks did well because of the Delta variant, and in particular, the Delta variant has rekindled pandemic fears, which has pushed investors into work from home stocks. And the biggest work from home stocks are the five mega cap stocks: Facebook, Amazon, Apple, Microsoft, and Google, which constitute about 50% of the growth stock index. So growth stocks have done well in the third quarter, mainly due to Delta variant fears, and in the second quarter, it was reversion to the mean. Now I'd like to move from the hot spots in the market and now talk about the cold spots in the market. The bond market, again, is high on that list of cold spots. Not that bonds went down a whole lot. Rather, bonds essentially went nowhere, but they also don't really pay much in the way of income either, so they are in the cold category. Also in the list are what we call the reversion to the mean sectors. These are the sectors that were overbought and now are taking a bit of a breather. Story stocks are on that list again, so are return to work stocks that did well in most of last year but are now facing Delta variant concerns. Lastly, it's hard not to miss the softness in China equities, with regulatory edict after regulatory edict in China pouring cold water on sector after sector in recent months. But let's begin with the bond market. This chart shows the rate in the benchmark 10-year Treasury bond over the last 3 years, dropping from about 3.2% to the level of about 1.3%. The good news is that dropping bond rates lifts bond prices. The bad news is that rates have virtually no downside from here. And if rates do revert to pre-pandemic levels, that will be at the expense of current bondholders with lowering prices. So we've borrowed Leon Cooperman's gallows humor observation. It's hard to say if Treasury bonds today are offering risk-free return or return-free risk. This is the same slide we used on slide 11, but instead of looking at the top of the stack to see what's hot, we're now looking at the bottom to see what's cold. The most recent quarter has been tough for story stocks, though year-to-date story stocks are close to the S&P 500. The story stock softness is mainly the style taking a breather after the enormous returns in 2019 and 2020. Also, Delta variant fears likely played a role, as story stocks are more risk sensitive since fair value estimates are much more wide-ranging and open to interpretation. It's a little curious that the blue chip growth was the hot style in the third quarter, but aggressive story stock growth was the cold style. Alas, blue chip growth these days is more defensive than the days of yore. This reflects the fact that the five mega cap tech stocks, Facebook, Apple, Amazon, Microsoft, and Google, are some of the largest companies in the world, very different from decades past. So a Delta variant scare may well drive inflows into large cap growth ETFs, but outflows from aggressive growth ETFs. The disparity between these growth categories is likely to widen. Notably, the corporate finance pipeline is intimately tied to story stocks, so the soft patch in the last couple quarters has weighed on new SPACs, IPOs, mergers, and other corporate finance activity. Story stocks will not stay in the basement for forever. The present Delta variant fears, should they subside in coming weeks or months, could set up a scenario for increased risk appetite, not unlike the start of quantitative easing. We've used this slide in several of our presentations last year. It highlights that there are winners and losers during the pandemic. Industries on the left are the work-from-home companies that actually benefit from a pandemic, and on the right side of the chart are the return-to-work companies that get hurt amid a pandemic. These are further split, with those on the top that see permanent structural change in demand for better or worse due to the pandemic, and those on the bottom that just see a temporary change in demand that will soon revert. We bring this slide up again because the Delta variant has clearly rekindled this line of thinking. In the third quarter, most of the work-from-home stocks have outperformed, whereas most of the return-to-work stocks have underperformed. And should the Delta variant gradually disappear, it would seem this action of the third quarter will revert. But if another variant eclipses Delta, we will again revisit the slide, rinse and repeat until COVID is gone. While the return-to-work stocks and the story stocks have been the laggards in the third quarter, the biggest shortcoming in Q3 has been the China stocks. China N shares listed in New York are in a steep bear market, down over 45% from its peak earlier this year. The stream of regulatory changes and crackdowns has been profound and a bit frightening for U.S. equity holders. broad edicts have hit industries ranging from education to social media to finance to casinos to e-commerce and more. Beijing appears to be wrestling with its commitment to capitalism and is actively projecting a vision now known as common prosperity, a phrase that seems directionally aimed a bit towards communism. Some investors have suggested that China's new billionaires are threatening Xi Jinping's power base, and so the solution is to undermine their stock market-based source of power and influence. China stocks are trading at very low valuation levels at present, but of course it is difficult to say whether China is near the end of its crackdown or just the beginning. Our slideshow today mainly focused on Fed policy as well as brief commentary on the hot spots and cold spots in the economy and the markets. Beyond these hot spots and cold spots, there are still several topics that are very important. Some of these are fluid as legislation is still being crafted, like taxes and infrastructure spending. Along those lines, we're reasonably confident that taxes are headed higher, given economic recovery as well as very high government debt levels. We're also medium confident in increased infrastructure spending taking place. That said, we have little confidence that this will impact the earnings of infrastructure stocks directly, a movie that we've actually seen repeatedly over the last 30 years. Another important topic that's likely to be in the headlines more just in the next couple of months, it's likely that Pfizer will soon get an approval for vaccinating children in the next month or two, which will likely stir some controversy, but also target a segment of the population with low vaccine penetration and high exposure to others that are not vaccinated. We have not really discussed any of the military developments in Afghanistan or South China Sea, partly because of impact to the stock market via earnings and interest rates are fairly immaterial. That said, military developments can be black swan events, and so odds of black swan increase when changes are afoot. So these changes do need to be monitored. We are keeping an eye on those. Lastly, we frequently get questions about government debt levels, and in prior slideshows, we've included a few pictures on that. And while these figures have escalated quickly at the beginning of the pandemic, the growth in government debt is slowing, and so we'll probably update a little bit less frequently, but it is still of great importance. Again, please reach out to us by phone or email if you have any thoughts or questions. We would love to hear from you. Thank you again for listening to our Cedar River Capital Mid-Year 2020 Market Touchstones report. Please feel free to reach out and ping us if you have any questions or comments. Please take a look at our website, cedarrivercapital.com. And again, thank you for listening and thank you for tuning in.